Richard Wyckoff, 1873 to 1934, became a Wall Street celebrity. He was a forerunner in the investment world as he started as a stockbroker at the age of 15 and by the age of 25 already owned his own brokerage firm. The method he developed of technical analysis and speculation arose from his observation and communication skills. Working as a broker, Wyckoff saw the game of the big traders and began to observe through the tape and the graphics the manipulations they carried out and which they obtained high profits with. He stated that it was possible to judge the future course of the market by its own actions, since the price action reflects the plans and purposes of those who dominated it. Wyckoff carried out its investment methods, achieving a high return. As time passed, his altruism grew until he redirected his attention and passion to education. He wrote several books, as well as the publication of a popular magazine of the time, Magazine of Wall Street. He felt compelled to compile the ideas he had gathered during his 40 years of Wall Street experience and bring them to the attention of the general public. I wanted to offer a set of principles and procedures about what it takes to win on Wall Street. These rules were embodied in the 1931 course, The Richard D. Wyckoff Method of Trading and Investing Stocks, a course of instruction in stock market science and technique, becoming the well-known Wyckoff Method. Part 1. How Markets Move. Chapter 1. Waves. Wyckoff and the first readers of the tape understood that the movements of the price do not develop in periods of time of equal duration, but that they do it in waves of different sizes. For this reason, they studied the relation between the upward and downward waves. The price does not move between 2 points in a straight line. It does so in a wave pattern. At first glance, they seem to be random movements, but this is not the case at all. The price is shifted up and down by fluctuations. Waves have a fractal nature and interrelate with each other. Lower-grade waves are part of intermediate-grade waves, and these in turn are part of higher-grade waves. Each uptrend and downtrend is made up of numerous minor uptrend and downtrend waves. When one wave ends, another wave starts in the opposite direction. By studying and comparing the relationship between waves, their duration, speed, and range, we will be able to determine the nature of the trend. Wave analysis provides a clear picture of the relative changes between supply and demand and helps us judge the relative strength or weakness of buyers and sellers as price movement progresses. Through judicious wave analysis, the ability to determine the end of waves in one direction and the beginning in the opposite direction will gradually develop. Chapter 2. The Price Cycle. In the basic structure of the market, there are only 2 types of trading. Trends. These can be bullish if they go up, or bearish if they go down. Trading ranges. They can be of accumulation if they are at the beginning of the cycle, or of distribution if they are in the high part of the cycle. As we have already seen, the displacement of the price during these phases is done by means of waves. During the accumulation phase, professional traders buy all the stock available for sale on the market. When they are assured by various maneuvers that there is no longer any floating bid, they begin the upward trend phase. This trend phase is about the path of least resistance. Professionals have already verified that they will not encounter too much resistance, supply, that would prevent the price from reaching higher levels. This concept is very important because until they prove that the road is free, absence of sellers, they will not initiate the upward movement. They will carry out test maneuvers again and again. In case the offer is overwhelming, the path of least resistance will be down, and the price at that point can only fall. During the uptrend, buyers' demand is more aggressive than sellers' supply, At this stage, there is the participation of large traders who are less well informed and the general public, whose demand shifts the price upwards. The movement will continue until buyers and sellers consider the price to have reached an interesting level. Buyers will see it as valuable to close their positions, and sellers will see it as valuable to start taking short positions. The market has entered the distribution phase. A market ceiling will be formed, and it is said that the big traders are finishing distributing, selling, the stock they previously bought. There is the entry of the last greedy buyers, as well as the entry for sale of well-informed traders. When they find that the path of least resistance is now down, they begin the downtrend phase. If they see that demand is present, and with no intention of giving up, this resistance to lower prices will only leave a viable path, upward. If you continue to climb after a pause, this structure will be identified as a reaccumulation phase. The same is true for the bearish case. If the price comes in a bearish trend, and there is a pause before continuing to fall, that lateral movement will be identified as a redistribution phase. During the downtrend, sellers' supply is more aggressive than buyers' demand, so only lower prices can be expected. Being able to determine at what stage of the price cycle the market is at is a significant advantage. Knowing the general context helps us avoid entering the wrong side of the market. This means that if the market is in a bullish phase after accumulation, we will avoid trading short, and if it is in a bearish phase after distribution, we will avoid trading long. You may not know how to take advantage of the trend movement, but with this premise in mind, you will surely avoid having a loss by not attempting to trade against the trend. When the price is in phases of accumulation or uptrend, it is said to be in a buying position, and when it is in phases of distribution or downtrend, it is said to be in a selling position. When there is no interest, that no campaign has been carried out, it is said to be in neutral position. A cycle is considered to be complete when all stages of the cycle are observed: accumulation, uptrend, distribution, and downtrend. These complete cycles occur in all time frames. This is why it is important to take into account all the time frames, because each of them can be at different stages. It is necessary to contextualize the market from this point of view in order to carry out a correct analysis of it. Once you learn to correctly identify the 4 price phases and assume a totally impartial viewpoint, away from news, rumors, opinions, and your own prejudices, taking advantage of your operative will be relatively easier. Chapter 3. Trends. Prices change, and the waves resulting from those price changes generate trends. The price is moved by a series of waves in the direction of the trend, impulses, which are separated by a series of waves in the opposite direction, reversals. The trend is simply the line of least resistance as the price moves from one point to another, because it follows the path of least resistance. Therefore, the trader's job is to identify the trend and trade in harmony with it. When a market is rising and encounters resistance, sales, either exceeds that resistance or the price will turn. The same happens when the price is falling and encounters resistance. Either exceeds those purchases or the price will turn. These pivot points are critical moments and provide excellent locations to trade. Depending on the direction of movement, we can differentiate 3 types of trends: bullish, bearish, and lateral. The most objective description of an uptrend is when the price makes a series of rising impulses and falls, where highs and lows are increasing all the time. Similarly, we identify a bearish trend when highs and lows are decreasing, leaving a series of decreasing impulses and regressions. Finally, we determine a sideways environment when highs and lows remain fluctuating within a price range. Trends are divided by their duration into 3 different categories: long, medium, and short term. Since there are no strict rules for classifying them according to the time frame, they can be categorized according to how they fit into the top. That is, the short-term trend will be observed within the medium-term trend, which, in turn, will be within the long-term trend. Types of trends. Note that all three trends may not move in the same direction. This can present potential problems for the trader. In order to be effective, doubts must be eliminated as much as possible, and the way to do this is to identify in advance the type of trading to be carried out. A very important condition to take into account when selecting the type of trading is the timing. Entry calibration. Success in any kind of operative mainly requires a good timing, but success in short-term trading requires a perfect timing. Because of this, a beginner should start with long-term trading until he achieves consistent success. Because trends may be different depending on the time frame, it is possible, but difficult, to have buy and sell positions at the same time. If the medium-term trend is bullish, you can take a buy position with the expectation of holding it for a few weeks or months. And if in the meantime a short-term bearish trend appears, you can take a short sell position and hold the buy trade at the same time. Although theoretically possible, it is extremely difficult to maintain the discipline necessary to maintain both positions at the same time. Only experienced traders should do this. For the initiate, it is best to trade in harmony with the trend and not to trade on both sides simultaneously until consistently profitable. You must learn and understand the reasons, behavior, patterns, and emotions that control the market. A bull market is driven by greed, while a bear market is driven by fear. These are the main emotions that drive the markets. Greed leads to paying higher prices until it leads to what is known as an overbought condition. On the other hand, the panic caused by falls leads to wanting to get rid of positions and sell, adding more momentum to the collapse until overselling conditions are reached. Having these emotions is not a negative thing, as long as they know how to move towards a positive aspect, and it is very clear that what is really important is the protection of capital. Chapter 4. Assessing Trends. This interaction between supply and demand, as a trend develops, will leave clues in the confirmation of the price action. We have different tools to help us assess trends. Judiciously assessing the trend is key to determining your health. It allows us to detect if any force gives signs of weakness, or if the opposing force is gaining strength. Our job is to go for strength and against weakness. Strength or weakness analysis. When the price is in trend, we expect greater strength from the pushing side. We have to see it as a battle between buyers and sellers, where we will try to analyze the strength or weakness of both. The best way to assess current strength or weakness is to compare it with previously developed movements. A weakness in the price does not imply a change of trend. It is simply a sign of loss of strength and tells us that we must be prepared for future movements. There are several ways to analyze market strength or weakness. The key is comparison. Absolute values are not sought. It is a question of comparing the current movements with the previous ones. Speed. Speed refers to the angle at which the price moves. So if the price is moving faster than in the past, there is strength. If, on the other hand, it is moving slower than in the past, it suggests weakness. Projection. With this tool, we evaluate the distance that the impulses travel and compare them with the previous ones to determine whether the strength has increased or decreased. For a trend to remain alive, each impulse must surpass the previous impulse. If an impulse is not able to make new progress in the direction of the trend, it is an alert that the movement may be reaching its end. Depth. With depth analysis, we evaluate the distance traveled by trend reversals to determine whether weakness has increased or decreased. As with projection analysis, we can evaluate depth using two measurements: the total distance of the recoil from its origin to its end, and the distance the price travels from the previous end to the new end. Lines. Lines defines the ranges and define the angle of advance of a trend. They are of great visual aid for the analyses, being very useful to evaluate the health of a movement. So much to identify when the price reaches a condition of exhaustion as to value a possible turn in the market. In general, they help us to foresee levels of support and resistance at which to wait for the price. At the same time, an approach or touch of those lines suggests the search for additional signs to look for a turn, offering diverse operative opportunities. The more touches a line has, the more validity the level for the analysis will have. You must be careful not to draw lines indiscriminately, especially on very minor movement. The correct handling of lines requires good judgment, otherwise it will cause confusion in your reasoning. When the price penetrates a line, we must remain more alert and be prepared to act. Depending on the position where the break occurs, as well as the action itself, we can suggest different scenarios. A thorough understanding of price and volume action is needed to determine the most likely scenarios. Horizontal lines. A horizontal line identifies an old zone of imbalance between supply and demand. When it connects at least two price lows, it identifies a support. This is an area where buyers appeared in the past to outdo sellers and stop the price drop. On that area, it is expected that buyers will appear again when it is visited again. A horizontal line connecting at least two highs identifies a resistance and is in an area where supply outpaced demand by stopping a price hike. That is why sellers are expected to reappear on a new visit in the future. When a line serves both as support and resistance, it is known as a shaft line. Prices tend to revolve around those axis lines. Those price levels are constantly changing roles. A broken resistor becomes a support, and a broken support becomes a resistor. Trend lines. After identifying the nature of the trend, the next step is to build a guideline in order to take advantage of the movement. It is the simple connection between two or more price points. In a bearish trend, the trend line is drawn by connecting two decreasing highs. This line is called the bid line because it is assumed that the sellers will appear on it. In an uptrend, the trend line is drawn by connecting two rising lows. This line is called a demand line because it marks the point where buyers are supposed to appear. We can continuously readjust the trend lines in order to adjust the one that best suits the price action and therefore generated the most touches. The more times the line has been respected, the stronger we will be able to interpret it when it is played again in the future. Note that a line with too much slope will be broken too soon, so it will not be drawn correctly. As long as the price remains within the established levels, it is said that the movement is healthy, and it is appropriate to consider maintaining or adding positions. When the price approaches a trend line, there is a threat of breakout, and this may mean that the strength of the trend is being exhausted, suggesting a change in the speed of the trend or a definite danger of reversal of the trend. Break out a trend line by itself is not a conclusive sign of anything, as it may be a true or false break. What is significant is how the line is broken, the conditions under which it happens, and the behavior that precedes it. After a movement of a certain distance, the price may find resistance to continue, and this will cause the trend to change its speed and rest. During the break, lateral movement or range, the force that originally drove the trend may be renewed or even strengthened, resulting in a continuation of the trend with greater momentum than before. Under these conditions, it is necessary to reposition the trend lines to conform to the new set angle. For this reason, it should not be accepted that the mere fact of breakout the trend line is a reversal of the same. Channels. The ideal channel will have several touch points and should capture most of the price within its limits. When the bullish trend line, or demand line, is dragged towards the opposite end and anchored parallel to the high that lies between the two lows used to create it, the overbought line is created, and together they define an upward trend channel. This channel identifies a rising price. The trader should be aware of overbought conditions. These conditions are created when the price exceeds the high end of the bullish channel. Due to a too fast acceleration, the price reaches a point at which it is highly sensitive to long coverage and generally to the withdrawal of more experienced buyers, suggesting a weakening of the uptrend. They usually guide the price to a downward corrective action. Human beings seem to be sloped towards ends. In the financial markets, this trend is revealed in the form of greed. Prices are pushed higher and higher until the public swells with stocks that are generally overvalued. When this happens, an overbought condition is said to exist. When the bearish trend line, or supply line, is dragged towards the opposite end and anchored parallel to the low that is located between the two highs used for its creation, the oversold line is created, and together they define a bearish trend channel. This channel identifies a falling price. The trader should be aware of overbooking conditions. These conditions are created when the price exceeds the low end of the downstream channel. Due to too fast a bearish movement, the price reaches a point at which it is highly sensitive to short coverage, profit-taking, and a general withdrawal of experienced traders who were sold, suggesting a weakening of the bearish trend. They usually guide the price to an upward corrective action. In a bear market, there is another extreme that takes control: fear. As the price falls, traders become alarmed. The lower they go, the more frightened they get. Fear reaches a level that weak hands can't stand and sell their shares. This selling panic generates an overselling condition. Those periods of overbought or oversold that lead to the stop of the movements can be seen in any temporality. Inverted lines. In high-speed conditions where a clear trend has not yet been established, inverted lines are a good way to try to set up, at least initially, the price movement. It is a question of first creating the line of supply in an upward trend to generate from it the line of demand, and of first creating the line of demand in a downward trend to generate from it the line of supply. At the beginning of a bullish advance, in case the price has made two important upward thrusts without leaving any significant bearish retreat, one can estimate at what point to expect the price to retreat by first creating the supply line in order to drag it and create the bullish trend line, and in the same way, first draw the demand line in order to create from it the bearish trend line. Converging lines. There will be times when you will notice that overbought and oversold lines created from their trend lines do not work effectively. The price may never reach these lines, as you will probably be following a different movement dynamic. The way to solve this deficiency is to create these lines independently, without taking into account the trend line. In this way, an overbought line would be created by connecting two highs and the oversold line by connecting two lows. The aim is to try to find the structural logic to the movements in order to take advantage of them. Note that in the case of an upward movement, not being able to even reach the original overbought line denotes a sign of weakness and alerts us to a possible downward turn. Similarly, the fact that the original overbooking line cannot be reached in the case of the bear movement denotes a sign of background strength and alerts us to a possible upward turn. Visually, they are observed as exhaustion patterns. Chapter 5. Trading Ranges.